Welcome to the Broken Pie Chart Podcast, episode 166. I'm your host, Derek Moore, and back with me this week, no surprise, since it is not an even-numbered podcast, is Jay Pestrichelli, my semi-permanent co-host, CEO of ZEGA Financial. Jay, how you doing this week?
Good, Derek. Great to be back. It is an even number. 166 is an even number, right?
Okay, well, it's not like top of the hour, bottom of the hour. So you missed 160, you missed 165. You're never on those, but
I gotcha. Yes, I was going by the strict definition of even versus odd, but I totally get what you're talking about. It's good to be back.
It's kind of like, good to have you back. I feel like it's kind of like, you're in Florida. The people who don't want to go to Disney on a Saturday, they always go like on a Tuesday. You always join the podcast on the off times. There's some method to your madness, I'm sure, right?
There is. And I have a method when to go to Disney and Universal. It's the best time to go is Labor Day weekend for some reason, right? It's, who's taking a vacation Labor Day right before school starts, right? So you're not getting the South American crowd coming in because they're just finishing up, and you got the American crowd just getting ready for school. Labor Day. That's my advice. That might be the best piece of information I give out on the podcast today. Disney, Labor Day.
Everybody should write that down. I do remember one time, and both of us went to school in the Northeast. We always started school after Labor Day. My parents, one time, we flew down to Florida. This probably was in the late 70s, but it was the first week of school. Like, they let me go to school a little bit late. I think the statute of limitations is up on that. It was in the 1970s, but there was nobody there. So maybe that's
right.
Another little thing as well. So
yeah.
Well, that's some good news, and let's get to what's that, Jay?
It's not Labor Day, so maybe not go Memorial Day. That's not a great week to go.
Yeah. So speaking of tips and news, and I don't know, I'm going to bring this up. Let's start here. Is bad news good news? And I'm going to put this into let me set the table, and then let's have some back and forth discussion on it. Deutsche Bank seems to be calling for a recession. Not seems to be. They think there's going to be a recession. They didn't say it's tomorrow. I think they're saying in 23 or by 24. They're the most negative on the street. Goldman Sachs GDP comes out Friday. Of course, when everyone in our audience is listening to this, GDP were to be out. Goldman Sachs has Q1 estimate of only 0.5% growth. And then GDP Now, the Atlanta Fed, nowcast, what is it right now based upon the information? They're 0.4%. I think the street consensus is something like 1.5%, although that might be lower. Jay, I bring this up because, there's a lot of stuff here. We could go stagflation. Let's hold it off for now. But if we get a lower print in GDP, does that help the market in a weird way? Because does that say that the Fed can't do too much, or are they in the box? What are your thoughts, Jay?
Well, yeah. So when you've listened to the biggest hawks on the street, like Bullard, for example, he has been saying the market can handle 50, 75 basis points. And that's really what started this latest move down, right, in the market. When was that? It was like the 20th, right? April 20th. And it's because the assumption was the market can handle if we're really aggressive in raising rates. If that story changes because GDP is not as high as expected, or even, there's a greater chance of a recession, that has to change the tune, right? That was their justification. So I do think you've got the scenario where lower growth in the U.S. economy will potentially slow down how aggressive the Fed can be. Now, I don't know, like, bad news is still bad news, right? Like, you and I have been talking about the fact that, all of the pieces that existed last year that caused the market to be pretty bullish are still hanging around, right? Relatively low rates and good corporate earnings, in other words, growth. Those things have still been around. But if that goes away, I still think it could actually be bad news. Bad news could be bad news. But I do see your point of saying bad news could be good news, because right now this market is really being driven by the Fed more than anything else.
I mean, I guess the question is, how far is the Fed, to quote Sean Connery in the untouchables, what are you prepared to do? What is the Fed prepared to do? Are they willing to cause a mild, recession? I think there's a lot of, people on the street, and I'm one of those who thinks the Fed can go too far. And I'm not sure, you and I have been on record on this podcast saying we don't think raising rates will necessarily help inflation because it is a supply-driven issue. So I guess it's what are they prepared to do? And recessions all don't have to be 1929, 2008. But I don't know. Like, I think they're feeling the heat, so they have to raise rates, and that's why they're talking tough. But if we get a really slow growth, does that start to bring into stagflation, into the conversation? I don't know, Jay. I mean, that is a consideration, right?
Well, yeah, I didn't know if you're going to go with, bringing a knife to a gunfight quote when you started with the untouchables, but I do think you bring up a really valuable point here, Derek, that are we really going to affect inflation by raising rates? And I think there's some absolute yeses to that. We just heard a story of a friend of ours who bought property, right? And he's paying now 6% for his the mortgage, and he had to put down 2 points. And it's those kinds of numbers are going to slow down economic activity for sure. But the real driver, I don't necessarily think the real driver has been entirely the real estate market. I mean, there's a lot of other things that has pushed inflation higher. You got Russia, Ukraine. I don't think the Fed's going to impact them very much. You've got China putting more lockdowns in place, which is going to reduce the amount of shipping that comes out of that country. I don't think the Fed's going to be able to affect that. And so all of those things, wrapping it together, this really has been the thing we've talked about all year. Is the Fed going to make a mistake raising too fast? It almost feels like they're responding to a little public pressure. I'm not going to say political pressure. I'm going to say public pressure, meaning the Wall Street populace here, that there's a lot of people out there saying you got to raise rates because inflation's out of control. I'm not sure that's the right way to go. And keeping the economy strong and keeping it, giving it the ability to work its way through what we're going through from a geopolitical standpoint might be a better choice than raising 5 times over the next 2 meetings, right? That seems a little excessive.
It's interesting with the cause for inflation, and you mentioned the Russia-Ukraine thing. I'm going to be contrarian on here, and I'm going to say that alone didn't cause inflation to go up. Government's response to it may be added to inflation, meaning some of I was going to say the embargo. We're not doing an embargo, but the sanctions, things like that. So I think left in its own device, you can make the argument, wheat prices and energy, although I saw a note in Bloomberg today that I guess some European countries are paying for oil in rubles. So, I mean, they're still getting oil. I don't know that it's hurt the supply. But yeah, I mean, I think it's also, I mentioned stagflation. I'm not calling stagflation. And there's a little bit of, I don't want to say controversy, but some people look at stagflation as, okay, inflation that's rising and growth that's slowing. It doesn't necessarily have to be negative. Other people say, well, wait a second, there's got to be a third component to be stagflation, and that's higher unemployment. I tend to agree with the former rather than the latter. But Jay, I said 2 things there. I want you to be able to react to any or both of those too.
Okay, so I agree that inflation existed before the Russia-Ukraine conflict, but I will push back on you and say that it definitely pushed things like food prices, energy prices, and metal prices higher almost immediately after it. Yeah, the energy piece was more of a political response, but the wheat supply feels like that's because it's hard to farm your land while there's shells landing in your fields. So I do think there's some relationship there. That's the rest of it. I think I'm good with what you said, Derek. But I'm gonna. We haven't said this on the podcast yet, but a lot of folks thought that the bluff from Putin was meant to deliberately push inflation higher. Right? Whenever America seems to have an economic weakness, he's always tried to take advantage of that. Heck, I remember him saying in the middle of COVID, when oil had dropped dramatically in price, he came out and said, "Look, this is the time that we can break the frackers in America," right? And he flooded the supply, to drive prices lower. So I really did think, maybe that's not a popular opinion, maybe it is, I don't know, but I do think that it was part of his intention was to help, continue to, maybe put a little salt in the wound of the inflationary problems in America. But of course, turns out his intention was much different. We didn't, realize that at the time. Speaking of which, to our developers that are helping us, you guys are still in our thoughts always. I'll leave it at that, Derek. But besides that, I will agree with the rest of your points that you made.
Yeah, no, it's fair enough, and it's a fair point to make. And I mean, look, responses to anything, and whether it's traders buying and selling, in the end, it's market and emotions and buying and selling that makes the market. And people's decisions sometimes are expressed in the way they vote, and the way they vote is buying and selling shares. You did mention some of the economic implications. I also think, getting back to maybe the supply side in particular, we were very early, I think earlier than anybody on it, like a normal mainstream financial podcast or media, talking about shipping and container rates. And we know since everyone's been talking about that. I don't know for sure yet. China, the news is, and I'm just reading this off news reports, they've essentially locked down Shanghai. That's a city of over 20 million people. There's rumors they might lock down Beijing. I don't follow this enough to call myself an expert by any stretch of the imagination. I did see some data that there's a lot of ships waiting off the coast of China. I don't know. Maybe this is something that inflation, the rate of change year over year, based upon the inflation nowcast by the Cleveland Fed, is expecting about 8.14%. That would be a lower rate of change than the previous month. But I don't know. I mean, maybe some of this stuff in China works its way into it. I don't know, Jay. I'm not convinced yet that we've seen the end of inflation. I don't know if it's the top, but some people are calling for it to be closer to the top than we've been. I don't know, Jay, if you have any thoughts on that.
No, I don't think the issues between the ones we just talked about, I don't think they've worked themselves out yet. I mean, I know there's folks calling for peak inflation because we may get a lower rate of change coming out shortly, but I don't see the 3% number anytime soon. So regardless if it's flattening out a little bit, because it's not that much of a dip, right? Like, what is the you just said what, 8 plus
8.14? Yeah, 8 plus.
Okay, like that's not much lower than we had last month, and so I don't know if it's peak or not, but regardless, still not great. It's still going to slow down economic activity, especially with the part of the population that is most impacted by inflation, which is a huge part of the U.S. consumer base. So I definitely don't. To me, it's not over. We're not seeing fives, I don't think in the next month or so.
I think I would agree with that. Jay, you mentioned earnings. I did want to bring real quick into the discussion as well. Refinitiv, and I think they use IBS data. They put every Friday, and I'll put a link to this in the show notes for everybody to take a look at, an earnings dashboard. And basically what they do is they take a blended quarter to date. And so you've got the remaining expectations for companies that haven't reported and the actuals. And so far, the blended earnings through last Friday was plus 8.3% on the S&P. Revenue was up plus 11.9%. I'm bringing this up, Jay, because you mentioned earnings are still growing. It is interesting, by the way. A lot of people said, financials would be the place to be if we got interest rates going up because they'd make more in loans. The spread on cash would be greater. They've been hurt by that, although others argued that we have a flattening yield curve. Financials, that blended is down close to 19% year over year earnings growth. So it is interesting. Yeah, to your point, yes, earnings are still growing. I know yesterday Google missed, but then they go and they announced, what was it, like a $90 billion buyback authorization? That seemed to temper that a bit. But yeah, Jay, I mean, and I guess there's 2 points here. Yes, earnings are growing. Energy, by the way, if you take out energy, the earnings don't grow as much. But financials, right? I mean, people would have thought financials and maybe the XLF ETF would have been much better off price-wise than they are right now, right?
Yeah, I mean, we speculated on the same thing while we didn't have a position on it. It certainly was something we were interested in looking at, using the XLF, the financial index, as kind of an offset for rising rates, and that just hasn't been the case. A few things to point out about that ETF, and I will give you 100% credit for this, is that there is a large Apple component to XLF. How is that the case? Well, there is a large Berkshire Hathaway holding in XLF. And Derek, what is the percentage of Berkshire that holds Apple?
Yeah, this was surprising, and obviously we don't have up to the minutes. We don't know what's in their portfolio, but it was 47% according to what I read as of the end of the year. Yeah, I mean, crazy.
Yeah, so it's just one of those things that there's a lot of dynamics. Sometimes you got to dig into the details when it comes to those sector ETFs, and I get why Burke is in there, but I'm not saying that's why the ETF is down itself. I think there's things like yield flattening and potentially lower loan activity that can all contribute to the financials not doing as well when it comes to earnings. But generally, you think rising rates, banks earn greater net interest income, or NIM, net interest margin, but in this case, it doesn't seem to be happening. Right, odd one there. Can I pick out another odd one while we're talking specifics in the market here, Derek, that continues to befuddle me, and I think you know where I'm going?
Absolutely.
Yeah. We've been watching utilities and scratching our head as to why they continue to go higher. Right, earnings on utilities are not growing. You've got higher costs, input costs, obviously. You've got limitations on what you can earn as a utility, and you've got a rate sensitive vehicle, right, because of the dividends. Yet all those things would, generally be bearish against XLU. I'll use XLU as the guide here, but guess what? Not the case. XLU, with the exception of the last couple of days, has pushed to new highs. Scratching my head on this one. I'm not sure if you want to comment on that one, but just another oddity in the market that sometimes what you think might be the case, you get the exact opposite.
I mean, let's look at, I think, in Florida. So is it Next Energy? They're a Florida-based company. And I guess one could say, okay, well, energy companies are getting a bid, certainly because the increase in earnings that energy is going to have. This is where I always say, I can play an analyst on TV, but I'm not an analyst. Like, I'm not digging into the balance sheets and the businesses in these underlying companies like some people do. So the question is, I mean, are they passing higher cost on to customers, right? Because a lot of these utilities are passing cost on to customers, right? So I agree. And maybe it's just getting a bid with the whole energy complex, because normally, Jay, people buy energy and they might buy XLU for the dividend. And we've seen in the past when interest rates go up, these tend to fall because given the choice, you'd rather have a treasury bond at 2.5 rather than an energy or a utility ETF yielding 2.5, right? So I agree. I haven't done the work on this, Jay, but I do agree it's a little bit of a head scratcher, right?
Yeah, a little head scratcher there. I know we got a little deep on that one, but something interesting to watch.
Just to tie a bow on the Berkshire Hathaway point too, it is interesting. So I said, they at the end of the year were holding about 47% of their holdings were in Apple. Berkshire makes up of the XLF, the financial ETF. They were 15.7 or 15.17% of the assets. So, rounded up to half, you almost have, or you did. We don't know what they have now, about a 7.5% allocation in the financial ETF to Apple. I mean, Apple payments, I guess you can make the argument there, right? But yeah. And they hold Bank of America. Yeah, and they hold Bank of America too. So you're doubling up on Bank of America, right? So, and I think our point here is, we want to move on from this, but if you're trading ETFs, like, you always got to look at the underlying. And if there are anomalies like Berkshire, take a look and see what are they holding. And sometimes you have different risks than you think, right? So, Jay, speaking of financials, and we said something that people thought would work, and year to date, they have not been working. The other thing I wanted to bring up is, I don't know about you, but I've been getting some questions from advisors and clients on, hey, I haven't been in commodities, but I'm thinking about getting in commodities now. And we know commodities certainly have had a good run, no doubt about it. But commodities over time, we were looking at some data, and this is somebody did a blog post on this. They referenced data from Deutsche Bank. And Jay, you want to take this one and kind of lay the framework for what we're looking at here? A little different, yeah.
Yeah, no, the information is definitely interesting here. It's when why commodities, right? Why do people think commodities are kind of a good investment? And certainly in times where you have potentially declining stocks, declining bonds, where else are you going to go? Some folks go to commodities because in this inflationary environment, maybe that ends up being you want to own oil, right? Or you want to own wheat, or you want to own precious metals. But the thought here is it really worth it over time? Is the return worth owning commodities? And maybe there's a week long or month long trade in there for you, but is it worth owning them? And when you look at commodities performance on an inflation adjusted basis, they actually perform pretty poorly compared to stocks and bonds on an after inflation basis. So, quick example here, right? Like if we look at say the last 5 years, right? Commodities average per year on a after inflation basis about minus 5.5%. On a 10-year basis, like minus 9%. The last 15 years, minus 7%. So it's one of those things that if you've been long commodities for a long time because you think it's an inflation play, when you apply the inflation factor to it, they're actually not beneficial or constructive to growth compared to, say, stocks and bonds that have been constructive over those same times. So stocks, same period of time, over the last 5 years, up 10%. Over the last 10 years, up 10.5%. Over the last 25 years, up 7%. So it's one of those things that while, switching to commodities may seem to be, wise in an inflationary environment, on an inflation adjusted basis, they end up not providing a lot of benefit to the portfolio.
I mean, you and I will readily admit, we don't know what's going to happen with commodity prices on the short term. And everything we do is built around buying and hedging and being invested and staying invested, right? So, I don't know what commodities are going to do. It feels like people buying here were a little late to the party. It's like the guy selling TVs at the Wiz in the 1990s with a prospectus for the Emerging Markets Dragon Fund in his back pocket when emerging markets was already up 100% over the year.
That sounds like a real experience you had there, Derek. The Wiz. You want to tell me what the Wiz was? Nobody beats the Wiz.
Nobody beats the Wiz. So the Wiz was an electronics store. I don't live on the East Coast anymore, but they sold electronics, TVs, radios, stuff like that. So you go into the Wiz, kind of like an early Best Buy.
It's like a high pressure Best Buy. You go in and have some fun and negotiate for your TV or even
salespeople negotiating, literally negotiating with you. I don't know. I got to go talk to my boss. It's at the end of the month. I don't know. And so you're haggling with these people. It doesn't work that way anymore. But I remember this guy. We start talking about what I don't know how we got there, and I noticed he had the prospectus because it was sticking out of his pocket. I'm like, that's the Merrill Lynch Dragon Fund. And he's like, oh, yeah, they're only going to go up. They're only going to go up. They were already up 100%. Next year, they were down like 40, 50%. I'm like, that's always your contrarian indicator. So it feels
that's a good one, right?
Feels high. It feels high. I have no idea what they're going to do. I really don't. I'm sorry. But I do know over the last 100 years, Jeremy Siegel is a big fan of this. Over 100 years, stocks based upon this data up over 7.5% after inflation. Annualized, commodities down 1%. So to me, it always goes back, Jada. If that's the thing historically that's been the best after inflation return over the long period, why not own more of that? And then why not own it and then hedge what you're afraid of directly on that? And it really comes back to the whole buy and hedge methodology, right?
No, absolutely. And listen, no one's saying that commodities were a bad trade this year, right? I mean, they're obviously up.
Would have been great. go in your time machine and load up on those, right? Yeah.
Yeah, I remember exactly. I don't remember which episode it was, Derek. I said, I think I take the other side of commodities. I guess I'm doing the same thing still. And I would have been incorrect when I am incorrect when I said that on our Contrarian Corner session that we did probably 2 months ago. But, long term, right? This is like, you just nailed it. If you're trying to grow your money over the long term, why not go with the thing that has the greatest chance of success, right? And stocks have proven themselves to do it. Now, it doesn't mean take all the risk associated with stocks, as you said. So limit the risk in the vehicle that you're in, right? Hedge directly on the market that you're invested in, and you could do that with options on the U.S. stock market, which is our preference because it's just worked more often, right? Like I know it's a little easy to say just go with what works most often, but that's how easy it is, right? I tell folks all the time, go with what works more often than not, right? You don't have to be a wizard in the market to try to figure out what sector rotation is going to work or what asset rotation is going to work. Go with what works most of the time. Most managers in our space don't beat the S&P 500. They just don't. So why not start with that? Because it works more often.
We actually did and I'll link to this in the show notes as well, a article on the ZEGAfinancial.com blog. And I think the premise, actually, no, we haven't put it there yet. Maybe we will. But here's the data. We looked at like the last 5 or 6 years, and we looked at the AGG, U.S. Aggregate Bond Index, right? Great proxy for, you got treasuries, you got corporates, you got different stuff in there. And this year, no surprise, year to date, it's down on a real basis, on an after inflation basis. Okay, no surprise. No surprise last year was down on a real, return basis. And even the past 4 years, what was it like 0.2%, 0.5% after inflation. So, even in recent times, we just talked about commodities, just getting back to bonds. Bonds at these low rates, who knows what's going to happen, but I'm going to say, I think there's no way they get the returns they have in the past at these low rates. And certainly on a real basis.
Yeah, no, look, I mean, you're not really going out on a limb there, Derek. And, we've been, traveling and doing seminars and talking to people about this. And we really do come down pretty hard on bond positions. But I do think it's worth mentioning that doesn't mean there isn't a place for bonds when you have a specific reason for them in a portfolio, right? We just got off a conversation with our investment committee where we discussed how using bonds, the actual, say, treasuries themselves that have a specific maturity date, you could structure defined outcomes around those, knowing that if you're willing to hold the bond to maturity, you have an expected return because once you buy that bond, you know what you're going to get at the end, right? If you can hold it to the end, to hold it to maturity. So, while I think in general holding bond funds as an allocation component is going to be really tough to provide value in this environment that we have this year and next year, it doesn't mean that there isn't a place for them with specific defined outcomes, right? I don't know if you want to expand on that at all.
Yeah, no, I think you're right on that, and we use bonds as a funding source. We don't do it as normal. I don't want to say normal advised. Like the general use of a 60-40 portfolio is 60% stocks, 40% bonds, and the idea that bonds go up when stocks are getting hammered. This year, that's not the case. Bonds may be causing the problem. Rates are causing, interest rates and things like that are causing the problem in, the stock market, in my opinion. Could be wrong, but that's my opinion. And so, yeah, I mean, it gets really interesting. And we are option managers. We really specialize in that domain. And so we can create bond-like positions using options and also utilize something like a treasury where we're stacking those two together and we're also defining the risk and limiting that risk a little bit more. It's just a really fancy way of saying a different way to be hedged because you're limiting the losses. So, yeah, and I think the treasury, by the way, treasury going up and being, I say this high of a yield, and I'm like smiling because really, like, is 2.5% on a 2-year treasury a high yield? I mean, come on, it's nothing. Like,
no,
it's really nothing. But it does open up some other possibilities, Jay. Maybe that's a topic for a future one. But I think for investors, this gets the possibilities a little more interesting than they've been. I don't know if you want to say anything on that. I did have a quick thing on VIX before we wrap it up, though, Jay. But I'll pass it to you first.
Now let's move over to the VIX. That's where we beat up bonds. What we said we could use them in with just certain uses.
So last thing I want to bring up is you and I obviously watched the VIX, the volatility index, which measures the 30-day implied volatility of a group of options on the S&P 500 index. Just a quick observation. I remember the VIX, like 2008, 2009, VIX was high, remained high, but I don't remember if I recall a time when the VIX has been this high and then keeps, going back up to 30, then coming back down, going back up to 30, as we've seen. I don't know if I'm wrong in my observation on that, but it is high. But I feel like normally it's high and then it comes down. It seems like it keeps wanting to go up. I don't know if you've noticed that, Jay, or if you have any thoughts.
Yeah, my thoughts on the VIX are that it goes in waves of periods of higher or elevated volatility and periods of lower volatility. And these are, it doesn't mean the 1 week spikes don't exist, but when you look back over say the last 20 years, there are distinct areas of time or ranges of time where the VIX is relatively low and volatility is low, and you're kind of surfing around that 10 to 15 range most of the time, right? If you look at the lows of those periods. And then there's other times where the lows are much higher, right? Above 16, floating near 20. I'm looking at the VIX chart here. There have been very few days where the VIX has closed below 20 this year. That is odd. But we started this period of higher volatility in February of 2020. And these periods of higher volatility to me last 3 to 5 years, right? That seems to be the general range. So take a look at a 20-year chart on the VIX, and you can see these periods of low vol and periods of high vol. And I think we're in the middle of a period of higher volatility. I think the volatility kind of begets more volatility, right? It kind of does it to itself. It's one of those things. It's like fear builds on itself. And so it's not all that surprising. But I would agree with you, Derek. We're in a period of higher volatility. That period started in February 2020. We're 2 years into it at this point. We've probably got another year and a half. And so if I was to, okay, so what do I do with that information, right? Does it mean I should hedge? Sure, yeah. You want to manage your risk even more carefully in a period when volatility can work against you. By the way, when we talk about, maybe I shouldn't go too deep into this. When we talk about volatility, we're talking about kind of the daily change or the rate of change in a portfolio, the rate of change in the market, right? And the wider the higher that magnitude is, the higher volatility is. And volatility in general is bad for a portfolio. I mean, from a trading perspective, it creates plenty of opportunity. But portfolios that move plus or minus 0.5% every day are much better off than portfolios that move plus or minus 2% a day, right? The math just works against you, right? And we don't have to go into all the details on that, but it's not better to have +2, -2 than to have +0.5, -0.5, right? It's much better to have those lower volatility returns over time. And so you want to be careful and you want to protect yourself in periods of higher volatility. But that's not the only thing that you should do. I know I'm probably bleeding into a different topic here, Derek, but you want to have in your portfolio some sort of a strategy that can benefit or harvest higher volatility. And there's not a lot of places that could do that. Options are a way to do it. If you're an options trader that likes to sell volatility, whether you're selling premium on calls or puts, you know exactly what I'm talking about here. Derek, people can reach out to you if they have questions about what that really means. But and you can give your details in a second there, but I do think, I'll wrap this whole thought up. We're in a period of higher vol, and you want to have strategies that can benefit from that. Options are one way to do that.
Yeah, absolutely. And it's derek.moore@zegafinancial.com. That's derek.moore at ZEGA. Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financial's up to you to get correct on the spelling. You can email me and let me know about future topics for episodes. I do like getting those emails, and sometimes we turn those in. Or if you want to find out a little bit more about how we hedge or sell volatility in some of our strategies, obviously, to take advantage of the heightened volatility, happy to go over that with you and set up some time. Or just email me for movie recommendations. I'm happy to give those as well. And by the way, I saw Elon Musk I think they sent another manned space mission. And I don't know if you get a chance to watch that Netflix documentary, but I was fascinated. I think it's called Returning to Space, how they put the first astronauts back in space with SpaceX. Like it's pretty high level stuff to design rockets that go into space, and then a rocket that comes, like the booster that comes back down and just lands itself. I don't know if you watched that, Jay, yet, but pretty fascinating, SpaceX.
Yeah, I did. I didn't watch it yet. I was recently a little out of commission with a little surgery that I had, and so I didn't. I was not really in tune to taking something that deep on. I instead watched all three versions of the Lord of the Rings. I had a lot of time to kill. So.
Lord of the Rings. Wow.
Yes, I had to catch up on that one. It's been a while, but no, it's on my list, Eric. So for sure, I love watching the. I think the scientific stuff is amazing, right? And
people are pretty polarizing on Elon Musk, and I know he just bought Twitter. It kind of changed my opinion on him, and I didn't have a strong opinion like other people, but I'm like, it's pretty fascinating just how they were able to accomplish that. And I guess the other thing I watched was We Crashed. I finished it. I'm going to say it's good. So I'll give that as a recommendation too.
Give it the 1 through 10 score that we.
Yeah, I don't know. I give it like a solid 7.5. I think.
Okay. So it's not Succession, it's not Billions, but it's still good.
It's good, and you know what? I mean, look, we all know the story of Adam Newman and We Crashed. I do think the character that Anne Hathaway plays. She plays the character that's his wife. They do make her look. I don't think the way she played the character, she didn't come off that well. I don't know how much of that is reality and stuff, but it's fascinating. And they have somebody who plays the character for Jamie Dimon in it too. So there's a really funny scene where he goes into a regular Chase branch and asks for a loan. And I'll leave it there. I don't want to spoil it.
All right, I will catch up on that one as well.
All right. Well, I think we've if the remaining listeners have not left, they will be leaving soon, so we'll probably call it there. Jay, appreciate you coming on again, and I think for everyone in the audience, like you want to be watching inflation, you want to be watching GDP, and let's see whether good news is bad news or bad news is good news or bad news is bad news or whatever the heck I'm trying to say. Jay, thanks again.
Thanks, Derek.
See you, everyone.